The SARB's quarterly report indicated that household debt rose, with debt service costs as a percentage of disposable income in the second quarter rising to 64.6%, up from 64.3% in the first quarter. While a cause for concern as households battle the higher cost of living, these debt ratios are still lower than those recorded pre the COVID-19 pandemic.
There has been a tendency for people to start borrowing more in recent quarters, and that I interpret as being an indication that people are now borrowing more in order to compensate for the erosion of their disposable incomes through higher inflation.
During the second quarter, South Africa's trade surplus with the rest of the world narrowed, decreasing by 100 billion rand to 272 billion rand. The value of the country's exports has been coming down relative to the value of imports, and with the local currency weakening, this could spell the importation of higher inflation going forward.
Immediately after the Russian invasion of Ukraine as well, you got a surge in quite a lot of these commodity prices, the most beneficial of all being the price of coal, an important export of South Africa. What we are now seeing is that the counterbalance to these rising commodity prices, they have driven inflation up all around the world to levels that haven't been seen for 40, 50 years. And this is compelling central banks around the world to tighten monetary policy, to increase interest rates sharply. And in anticipation of a major slowdown in global economic activity, commodity prices have started falling.
Ultimately, the country's current energy challenges are likely to undermine any future economic growth prospects, in the short term at least.
Undoubtedly, it is going to result in the need to revise downwards forecasts for economic growth. I don't think most of the models that have forecast South Africa's growth have anticipated us going into a stage 6 kind of situation.
One of the positive outcomes in the second quarter was a boost in private sector investment, which contributed to the growth of real gross fixed capital formation, which rose by 0.5% on the first quarter. A significant chunk of this investment includes the private sector's building of new energy capacity, following government making it easier for private players to produce up to 100 megawatts of power, with that limit essentially removed in July. Nompumelelo Siziba, SABC News, Johannesburg.